One man's meat is another man's poison. This fully applies to what happened in the financial markets, specifically the cryptocurrency market, which we will talk about today. Giving a brief example. Let's say that in June 2011, a friend of yours said that there is a virtual currency called Bitcoin, which was only $1 2 months ago, but now it has reached $28. Then, immediately after you had heard that from him, you were galvanized. You made a swift calculation. If only I had bought $1,000 2 months ago, when Bitcoin was only $1, I would have had $28,000 now. Then after making your calculation in those few seconds, you asked that person how to buy those crypto coins. They told you how. So you bought Bitcoin with the value of all your savings, which at the time were worth $50,000. Then you fell asleep with your Bitcoins in the wallet, immersed in dreams of wealth. The kind of your new car, the new house, traveling, and new trips, and so on. You woke up the next morning, checking your Bitcoins and how much gain they have made. You found out that your $50,000 became $57,000. You thanked God, it was unbelievable, and you were over the moon. The day was over. You slept happily, and you woke up to check how much your net worth has reached, and how much more you have earned. But you found that the $57,000 were gone. Their value had collapsed, and they were worth $17 only. You were shocked by what you saw. You locked the wallet and reopened it. You restarted your PC. You restarted the modem. You even logged into the wallet from another device. Yet, the number did not change. Then your friend called you and told you that the value of Bitcoin collapsed and dropped to 1 cent per Bitcoin. The aforementioned story, though being tragic, but much more horrible stories do happen in reality. Cryptocurrency market is one of the most volatile and violent markets. Ups and downs with terrible gaps happen in a few hours and days. For example, in November 2013, the Bitcoin price reached $1,000 14 months later, but in January 2015, it collapsed to just $170. In November 2021, the price of 1 Bitcoin reached $68,000, and a few days ago, the price collapsed and approached only $15,000. These fluctuations are not limited to Bitcoin. They do happen to other cryptocurrencies as well. Since we are currently in the plunge phase, in other words, at a time when the cryptocurrency market is experiencing one of its worst times, we need to slow down and ask some questions of significance, such as, why are cryptocurrency prices experiencing such grapple fluctuations? Who is responsible for them? How can we predict the market motion by tracking the industry insiders? And above all, what is the best time to step inside and invest in the digital currency markets? What is the best investment strategy to follow? All these and other questions will be answered in today's episode. Over the past months and weeks, we have seen the dramatic downfall of cryptocurrency value for several reasons related to the global economic atmosphere, surging inflation, economic recession, adding that most central banks all over the world, led by the US Federal Reserve, adopted raising interest rates, as well as a set of turmoils that grappled the market, such as the implosion of Terra Lab with its currency Luna and its stable currency USDC. In addition to the Russian tendency to ban trading in digital currencies in early 2022, specifically before the Russian war on Ukraine. In such a blue global economic climate, investors are fleeing high-risk assets such as cryptocurrencies in favor of safer havens. This was reflected in the prices of digital currencies as a result, and we have already witnessed a continuous plummet over the course of a year. By November 2021 specifically, as the price of the most important and prominent currency among the digital currencies, Bitcoin, reached $65,000, the market continued to plummet due to the aforementioned factors, until it completely imploded a few days ago after the crypto empire founded by Sam Bankman-Fried, FTX, collapsed. Specifically, after the largest digital currency platform in the world, Binance, offered to acquire the troubled platform FTX, then withdrew within only 24 hours of its offer. This caused shockwaves in the cryptocurrency industry. After FTX filed for bankruptcy, the market plunged even more. Since November 2021 until now, the market capitalization of all crypto assets has dropped from $3 trillion to just $835 billion. Cryptocurrency prices are affected by supply and demand. So, because of the FTX platform implosion, users are afraid and withdrawing from the market, which led to an increase in supply. Thus, the prices went down. There is another category of investors waiting for such disasters to step inside the market and purchase. These seasoned investors use an old investment strategy called buy the dip. Here, it is necessary to slow down on such a strategy because it can answer a question that may be preoccupying many people's minds right now. If the market is plunged, isn't it an opportunity to invest and buy at a low price? Well, we will find that the buy the dip strategy explains this situation. What does this strategy simply mean? Buying the dip simply and briefly means buying a particular asset after the price plummeted. The idea hence is that investors and traders consider this asset's price drop as a profitable deal, as it will not remain low forever. It is natural that there comes a time when its value begins to rebound, and its price increases again. Therefore, market plunges are considered an appropriate opportunity for them to step in and buy at a low price, hoping that it will reap profits when the market recovers again. However, despite the possibility of achieving huge gains by following this strategy, there is one problem facing investors and traders during its application, which is estimating the downward trend. The strategy is based on the assumption that price declines are just temporary aberrations that will correct themselves over time. But what if they are not temporary aberrations? Here is the problem. Not every asset that has fallen in price has become a good buying opportunity. This means that if we miscalculated the downward trend and the asset that we bought continued to plummet, for example, we'll lose. We may have to keep the losing asset until the rebound occurs. One must keep an eye on timing and wherein the market is headed. This will not happen unless we are aware of everything taking place within it. So when it comes to making a decision, it is based on a sound basis. Now, if we want to summarize the buy the dip strategy in simple words, it would be: buying takes place when the whole market is selling, not when there is an overbought. Looking carefully at the screen, this chart contains two things. The black curve above it expresses the price of Bitcoin, and the orange curve below it expresses the number of wallets that contain at least one Bitcoin. We notice from the movement on the two curves that whenever a collapse takes place and the price of Bitcoin downfall, the number of wallets that contain one Bitcoin increases, which means that there are people who apply the buy the dip strategy and step in to buy Bitcoin at some point when the prices sink, as we see on the screen. For this reason, that period is called accumulation. Since we are talking about opportunities to step in the market at times of price decline, let's talk about another factor that affects prices apart from the sudden events that happen. We are talking about normal times here. Which party wages the industry up and down according to its interests? In order to achieve profitability by controlling supply and demand, the industry whales or the market top holders, those are not the regular kind of investors who would step in and buy for $1,000 or $10,000, for example. No, those whales step in with millions, maybe billions of dollars in order to reverberate the market and make profits. Those whales can be investment funds or huge financial institutions, or even a single person who manages huge numbers of cryptocurrency portfolios. According to the common expressions in the industry, who we call a whale is the one who owns at least 1,000 Bitcoins, for example. The issue is not always limited to large whales, as there are little fish that can achieve huge profits by following the movements of whales through the whale alert tool, whose mission is to monitor any movements that take place in wallets that contain a huge amount of cryptocurrencies that can affect the market. It became easy to predict what would happen to the prices once you knew that a wallet with $50 million in Bitcoin, for example, moved its coins from a cold wallet to a trading platform. How is that? Because this means, to a large extent, that this quantity has been transferred in order to be sold. Something of significance must be noticed here. When the whales knew that their movement had been monitored, and that there had been investors and traders who had been making investment decisions based on their movement, they made deft tricks wherein they move a huge amount of their cryptocurrency to delude the market that they are going to sell. For example, a shock wave hits the users, so they sell. However, they only wait for the price sunk over a certain point to make the purchase. So instead of transferring the equivalent of 3,000 Bitcoins to the platform, for example, They withdraw them from the platform to put them back in the wallet. But this time they put 3,500 bitcoins after the price downfall and buying another quantity. Do you remember the story I told you at the beginning of the episode about the person who bought bitcoins for all what they possess? Then they have lost everything. What mistake had they made to lose everything? The truth is that he was naive and stepped in the market at a time when whales are gathering their profits. They were shaking the market and raising the price to attract users more. He was amazed at the value of Bitcoin then. They decided to buy, yet the decision was galvanized by emotions rather than a profound schooling and understanding of the market tips and tricks. He believed during the purchase that the prices would continue to increase. But after the market is saturated and the prices reach a certain value, the whales start selling in order to collect the profits that they were targeting from the beginning. So, the industry plummets while that person is immersed in their dreams. You made us confused. What should we do exactly? Look guys, I am going to illustrate 7 rules that must be followed if you decide to step into this industry. First rule, invest only the amount you can afford to lose. That is, we should not invest or purchase with all that we have. Remember, there are people who placed everything they own into USTC currency and out of the blue the currency sank to zero. This negatively affected them. Some of them even committed suicide. Moreover, it is not only through a currency collapse that one may lose everything. Millions of dollars can be hacked, including your own. The platform could collapse as happened to FTX a few days ago. The second rule, stay away from new currencies or those that are trending. You may encounter those who suggest that a certain coin, worth 1 cent, will reach $100 or another will exceed $300. You will meet many of those people. When this happens, run away from them. This kind of currency was made to defraud and collect the biggest number of dreamers of quick wealth who get themselves into trouble and then the money is just gone. Rule 3. Keep your eyes on the major currencies, or as they are called, the top 10. These currencies have endured lots of ups and downs since they appeared and are still solid, so don't risk investing in currencies that are still not known for their ability to withstand times of turmoil. The fourth rule, diversify your investment. Bitcoin may have caught your attention, and you may be aspiring to invest all your money in it. But it is more wise to diversify your currencies in order to avoid any possible turmoil in the currency in which you have invested all your money. Diversify among Bitcoin, Ether, Cardano. Fifth rule, do not be greedy. The reason why many people are losing is that they are greedy. For example, you want to invest $100 to gain $1,000. This is not proper. Let your goal be making a profit at a certain and reasonable percentage. Let's say you set a goal that the $100 that you invest will make 25% profit. By the moment they will have reached $125, then you would have achieved your reasonable and logical goal. The point is, you guarantee that the market turmoil will not wind you down later after those gains. Sixth rule, stop losing. One of the conditions for successful investment is that you know when to get out of it. For example, you can't invest $100 while the market is down. The 100 would be plunging to 90. Yet, you are still waiting for it to rebound. Then you find the $100 has become $20. This is because you haven't specified how much loss should be enough to get you out of the firm. Rule 7. Determine type of investor are you. You should determine what type of investor you are. Are you investing in order to achieve immediate profit, or are you investing future profit? Because the two types are completely different in their investment method, manner, and strategy. If an investor wants immediate profits, they must be familiar with all the technical information about trading and its types, etc. But if you invest for the future gains, that is another matter. Thank you for watching. Subscribe to the channel for more.